Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Wednesday. It's November 4th. It's about 8:04 in the morning. The market's going to get going not probably. The market's going to get going in an hour and 26 minutes to be specific with you. Now, pre-opening, as you could see here, we're up about 18 points on the NASDAQ, but we're down on the Dow. Remember I said that the blue chips look a little overbought compared to the tech. The tech looks like it's a little more grounded. I showed you yesterday, as a matter of fact. And by the way, today's Fed day, so I'll get into all that in a minute. But I just want to show you what I'm seeing so you can understand my perspective. Notice here, looks like we're getting a little overbought here, just like we did right here. It's exactly the same scenario, and I think the market's going to start pulling back, especially after the Fed raises rates another 0.75 of a basis points, which is what's priced into this market. But if you look at the, let me show you the communication sector. This is the most lagging sector in the S&P. It never went up there. So, and one of the reasons that didn't happen is because earnings on FANG stocks, remember the communication sector, I just want to kind of give you a little feel for this. If you look at the constituents, Meta, Alphabet, Netflix, they have already reported, right? If you look at XLK, Apple, Microsoft, they've already reported, right? So a lot of what's in the tech in earnings on tech is already priced in. They haven't been picked up that much, and they have huge market cap. But on the financials, those have been running away because those earnings weren't as bad. But I think we're starting to catch up to it right now. And financials, industrial too. Oh yeah, industrial too. They all are starting to look tired and overbought. So I think we're going to see a little more selling pressure on the blue chip stocks instead of the communication, consumer discretionary, at least till earnings on consumer discretionary is out. That's not for another week, and technology. But this is really, really important stuff. Now, just to give you an idea of the latest earnings, as of last Friday, we had 263 members report. That's a little over 52%, as you could see here. So this week, we've got over 1,100 companies and 163, which about 63 have already reported as of today. So another 100 left. Now, for the ones that are out already, so far, we're pretty much flat on the EPS and 11% higher on revenue. And almost 72 have beaten EPS, and we know why, because the numbers have been beaten down to death. Here's the expectation that's on the table right now. 1% higher, 9.4% higher revenue. Revenue numbers are not going down nearly as much as I thought, which is good. That means people are spending, but profit margins on companies are getting worse, and that's expected. But the fact that consumers are spending, that people are spending, is a very, 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 very powerful sign. That's strong. Now, here's where we pull the rug underneath you guys. You always have to look for the rug pull, right? Excluding energy, third quarter earnings would be down 6.4%. That's how much energies are holding up earnings right now. 6.4%. I mean, can you imagine that? It's all in the energies. And for the full year, we've been pointing down. And this is the problem, and this is why I think markets are going to be choppy for the first half of 2023. We've already looking at estimates coming down for 2022, the full quarter of, so that means the full year, and full year 2023. Now, typically markets anticipate things about 6 months, give or take. It's not always, but about 6 months in advance. So if earnings are expected to continue moving lower throughout 2023, there's a good chance we're not going to see a major rally till about 6 months before that, when the market starts pricing it in. And that would also mean that these ARK stocks are in fact bottoming out, and that the worst is behind them, and we bottomed out here. Now, again, we may hit another low, a little baby low here, but notice we haven't really gone down on the small caps since May of this year. And also, as I point out, they peaked out almost a year before the rest of the market. That's why I'm looking at these, because they give us some foreseeability, because they're so speculative. Investors who are going to get bullish will start picking up on these stocks right away, or at least stop selling these stocks. And that's one of the reasons why when I look at the long-term charts, I'm kind of going a little overboard here. But notice we're getting to the pre-COVID levels. When we start getting to the pre-COVID levels, most of the downside is done. Like I was showing on stocks like Shopify, who have been beaten down. I mean, notice from 175 to $32. I mean, come on, guys. Let's be real here. That's pretty much done. So maybe we'll go another 5 points lower. Maybe we'll go another 5 points higher. But the bottom line is, I think the low is in for the speculative and the tech stocks, which tend to be more speculative. Now, remember, we've got a huge day today. Unfortunately, it's mostly priced into the market. What we're going to be listening to is how many times our Mr. Jerome, I'm not going to predict the future till I get reappointed, Powell, is going to talk about December. Right now, I'm thinking that in December, they're going to back down to 0.50 or maybe even 0.25 to kind of give us a wait-and-see bridge to see what happens, which may cause a little bit of a rally. But I wouldn't be holding our breath because ultimately I think rates are still on the ascent and they're still going to be going higher. And they are gung-ho in destroying this bull market economy. I mean, it's obvious. Then tomorrow we've got a lot of reports, factory orders, international trades and goods and services, but the big report is obviously today and on Friday, the employment situation. Now, let me give you a little pre-market preview of what's on the table and a little review of what we just discussed, and then I'll move forward into technical levels and give you, remember, it's Wednesday, my hot long stocks and my hot short stocks. So, three major U.S. indices were slightly were taken down by technology, consumer services, and industrial. Remember, I told you industrial is also showing signs of topping out, and I like industrial stocks right now. But industrial, and I think industrial stocks have been going up because they have a lot of defensive stocks like Lockheed Martin in them. I think if you look at the industrial stocks that are economy-provoking stocks, I'm not seeing anything there quite yet. Surveys show that U.S. labor remains strong, very important. U.S. job openings surprisingly rose in September, dimming hopes that the Federal Reserve might begin decelerating interest rate hikes. Yeah, we need to see wages going down, and they're not, and employment is good. At the same time, U.S. manufacturing activity advanced at its lowest pace in 2.5 years. That's why I'm saying industrial stocks that are non-defensive are part of that. Remember, manufacturing, industrial, it's like consumer discretionary and technology, right? Today, all eyes are on the Fed, 0.75 basis point rate hike. And what we want to hear is what they're going to talk about in December. And right now, what's priced into the market by about 50% is less aggressiveness, 0.50. And I like that. Crude oil inventories will be reported today. Economists estimate the figure coming in at 0.367 million compared to 2,588,000, which is huge numbers. So we're looking at a substantially lower number. Eurozone manufacturing PMI stood at 46.4, weaker than expected 46.6. The Shanghai composite today closed higher, recovering from a 31-month low on growing speculation that the country will scale back its strict zero COVID policy. Rumors circulating that China is considering full reopening by March 2023. Be still my heart. I mean, what are they doing? At the same time, the Nikkei, the Japanese Nikkei, closed slightly lower, and it made a 1-month high the other day, and it's now looking lower by utilities, energy, and natural like gas, water, natural resources type of stocks. Nothing really to write home about. Now, the bond market is what we need to pay attention to. We used to be in a channel that was from here to here, but as you could see, the support is now a very painful resistance. Now, we are in this channel, and I'm hoping we're going to stay within this channel. If we stay within this channel, it'll give the stock market some stability. Looking at the stock market, looking at the S&P is kind of between a rock and a hard place because it has a lot of the Dow stocks and it has a lot of the tech stocks. And I think we're going to start cooling off a little bit. The only positive is if you look at consumer stocks, consumer discretionary, and technology, they don't have a lot to go to get down there, as you could see. Whereas the Dow stocks, let me show you, see that? They're very close to the bottom. They're not near the 50-day line, where the Dow stocks, look at this. They're just running wild. Look at that. That's a weekly chart. Here's a daily chart. So you could see the run-up way past the 50-day, already at the 200-day line. No way near time to get bullish. But if you look at the SPY, It has a lot less to go. So I'm very curious to see how the large caps and how the blue chips are going to react today in light of everything we are seeing. Now, if you look at major sectors, you will see that energy, industrial, financial, healthcare, consumer staples are on the up and up. I would be very, very cautious with industrial and financial right now. Healthcare and consumer staples, I think, will hold on, but I think industrial is going to be married to basic materials, and financial sooner, and consumer staples and healthcare will come up, and industrial and financial will cool off and start coming down towards material, because they should be closer to basic materials, and the most defensive sectors are energy, healthcare, and consumer staples, and they should be leading right now, and I'm seeing more upside there. The downside, I think utilities are a little overdone. I think they're going to continue moving higher because energy is really up, and utilities and energy are best friends. Utilities is also defensive. I think that consumer discretionary communication services and technology are going to be coming up, but we do have fragmentation once again. Now, the top stocks and the bottom stocks, oh boy. I got one top stock and 3 bottom stocks. Oh yeah, it's like that. So I like Steel Dynamics. This is a steel company. I know it's industrial. I know what you're going to say. It's a steel producer, but steel manufacturers have been doing very, very well, actually. And the stock is now breaking out to a multi-year high, and it's pulled back 5 days, and I think it's going to go higher once again. Now, to the downside, I've got 3 stocks. Roku. Look at, so here's a 1 year chart of Roku. Nothing has been able to make it rally, and right now it's coming to the 50-day moving average, which will probably mean, and RSI is getting overbought, probably mean more downside, okay, on Roku. So I am bearish on Roku. I'm bearish on this Jinkoso Solar Holding. It's a Chinese solar company. Now think about it, folks. Would you right now trust Chinese solar companies? Of course not. And from where I could see, it's getting a little overbought too. It went from 40 to 51 on this run up. I think it's going to come up. This is a crappy company. I would not I would not go long a Chinese solar stock right now. That would not be what I would be doing. There would be a million other things I would do rather than that. And then last but not least, Signature Bank. Banks had earnings, and this stock just didn't do well. It barely went from 136 to 160, but I think this is going to start coming back down with the rest of financials. So I'm bearish on Roku, JKS, and SBNY, and I'm bullish on STLD. And I've become a lot more bearish over the near term because I think we're going to start cooling off and undo a lot of the gains that we've been seeing. Here's some of the stocks that I'm bearish on. Marriott, I'm bearish on this puppy here. I'm bearish on Six Flags Magic Mountain. The going out stocks. I think going out stocks have no business going up. Norwegian, what's Norwegian airline? Cruise line, excuse me. If they're an airline, we got bigger problems. I think they're going to start cooling off. Budweiser, I think Budweiser is, I think, a little too drunk for its own good. I think it's going to start cooling off. And a couple of other stocks, but I'm really bearish. And I think this Roku, JKS, and SBNY are going to be coming to the downside. I would check earnings first, but that's where I would be doing. Now, folks, before I let you go, with how unpredictable and dangerous the markets have been lately, and they've been very unpredictable and dangerous, it oftentimes makes it difficult to trade. And that's why I love the quantum indicator. One of the coolest things about this indicator, that it can signal long and short trades. I cannot wait for you to add it to your trading toolbox. It is literally perfect for this volatile market that's not going anywhere. Now, the indicator helps me quickly see which stocks are due for a pullback or a bounce, and I'm going live at 1 p.m. Eastern Time to show you what's signaling. It's very, very cool. You don't want to miss out. Now, during this webinar, I'll cover how to download, how to use the indicator. I cannot wait for you to add it to your trading toolbox, and I really believe it's perfect for this market. I'll also show you how it did compared to other indicators so you could see for yourself. It'll be eye-opening. Now, when I say eye-opening, I mean it's going to be eye-opening. Please set aside an hour at 1 p.m. Eastern Time today. You cannot afford to miss this training. Follow the link below this video Save the bookmark. Be there before 1 p.m. Eastern time today. You do not want to miss out. I'll give you some hot list trades. I'll do some analysis, and I'm going to show you how this indicator did on the Nasdaq and the S&P 500 over the last 20 years compared to a traditional indicator. When you see this, let's just say you're going to really want in on it. Follow the link below. Make sure to comment below this video, like these videos, and post questions in the channel, in the YouTube channel. I will respond. I promise I will respond. I will give you an answer, and it'll benefit others. Bye. Have a great, great day, and keep your powder dry for the Fed announcement today at, when is it coming out? Let's see here. It's coming out at 2 p.m. Eastern time. Bye, guys. I'll see you soon. Take care.